Welcome back to the Malaysia Money Matters show. It's the 4th of April 25. Today, we're diving straight into the latest financial news from Malaysia, looking at what's happening with our companies, the bigger international picture, and any political developments that tie in.
Yep, lots happening.
We'll cut through the noise and tell you what you need to know and why it matters. Let's start with some of the key movements in Malaysian companies.
Okay. It's a bit of a mixed bag today, showing how local businesses are navigating both domestic opportunities and some pretty significant global shifts.
Exactly. First up, HI Mobility, relatively new listing, has landed a substantial RM $134.94 million contract from APay.
Ah, yes.
This is for a 2-year gig running an intracity bus service down in Johor Bahru as part of that stage bus service transformation program. The markets seem to like this. Their shares closed up by over 3%.
Great news for them.
And the company anticipates it will have a positive impact on their earnings and net assets. A good sign for a newer player, wouldn't you say?
It certainly is positive news for HI Mobility. I mean, this contract provides a stable revenue stream and validates their business model in a sector with government support for upgrades.
Right.
We'll need to see, of course, how this translates into actual financial performance over the coming quarters.
True. Then we have Tuju Setia, a construction firm. They've been awarded a RM 264.07 million contract from Danal Sojana, which is a subsidiary of MKH.
Okay.
They're going to be building 4 blocks of service departments and some shop offices out in Cheras, Selangor. Expected to be a 34-month project, should contribute positively from FY 2025 onwards.
Seems solid.
Interestingly, though, the market's reaction was muted. Shares finished unchanged. Why do you think that might be?
Well, it's possible the market had already priced in expectations of contract wins for a company like Tuju Setia. Or perhaps investors are waiting for more concrete progress before reacting.
Or maybe just caution in the construction sector generally.
Exactly. Could also just reflect broader sentiment right now.
Now, T7 Global saw a much more dramatic movement. Their shares plunged by a significant 36%.
Wow, 36%.
Yeah, following the unexpected resignation of their executive deputy chairman, Tan Sri Tam Keen Soon. He'd been with the company for over a decade.
That's a long time.
It triggered a halt in intraday short selling. The company has reassured investors of their commitment to sustainable growth under their executive chairman.
It's a big drop, though. What's the immediate impact of news like this?
Well, a sudden departure of a long-serving key executive like that often creates uncertainty, big uncertainty. Investors might see it as a sign of, underlying issues or maybe a shift in the company's direction.
Right.
That sharp share price decline really reflects this immediate concern and the market just reassessing the company's stability.
Yeah, okay. Yinson Holdings also experienced a bit of a dip. Their share price slipped after announcing FY 2025 results, which apparently didn't quite meet analyst expectations for core net profit.
Missed forecasts. But the analysts seem to be maintaining a bullish outlook. Buy ratings, expecting a rebound in FY 2026, and strong growth in FY 2027.
So they're looking past the current numbers.
Seems like it. This optimism hinges on upcoming deliveries of new vessels and them overcoming some past cost issues in their EPCIC business, engineering, procurement, construction, installation, and commissioning.
Right, the EPCIC challenges.
And they're also actively pursuing new FPSO projects in Africa and Asia. So, yeah, a bit of a short-term setback, but the experts are looking at the bigger picture.
Yes, the analyst perspective suggests they believe the current underperformance is temporary. They think the future growth drivers, those new vessels and project wins, will outweigh these short-term challenges.
Makes sense.
However, the key for investors, obviously, will be monitoring the company's ability to actually execute on these future plans. Delivery is key.
Okay, now this is where we see a really interesting dynamic. Let's talk about glove stocks. Hartalega, Supermax, Kasan, Top Glove.
Ah, the gloves.
Yep, they initially saw declines, probably linked to the U.S. tariff news we'll get to. But then they staged a strong rebound.
A V-shape, almost.
It appears investors are seeing a potential advantage here. Even with the new 24% U.S. tariff on Malaysian goods, it's being speculated that Malaysian gloves might still be cheaper than Chinese ones in the U.S.
Interesting calculation.
Yeah. The Bursa Malaysia Healthcare Index actually saw a 2% increase on this. What's the underlying logic here?
Well, this really highlights how global trade policies can have unintended consequences and create unexpected opportunities, right?
Right.
The fact that the tariff on Malaysian gloves, while significant, is potentially lower than what Chinese manufacturers might face. Well, that could give Malaysian companies a crucial price advantage in the huge U.S. market. Could lead to increased demand.
So a competitive edge, even with the tariff.
Potentially, yes.
Conversely, technology stocks like Greatech Technology, Genetech Technology, Vitrox Corporation went the other way. Started with gains, ended up the biggest losers. The Bursa Malaysia Technology Index dropped over 1.6%. This seems tied to their U.S. market exposure and maybe concerns about future tariffs hitting semiconductors, even though they're currently exempt from Malaysia. So the market's forward-looking, huh? Sensitive to potential future risks.
Precisely. While the immediate impact doesn't hit Malaysian semis directly, the overall move signals a broader protectionist stance from the U.S. And that raises concerns about potential future measures that could affect these tech companies, given the U.S. is such a key market for them.
Right. Always looking ahead. Finally, in our Malaysian company roundup, the banking sector expected to see loan growth pick up after a slight slowdown in February.
Good sign.
Analysts are optimistic about balance sheet growth in 2025, pointing to strong domestic demand, those big infra projects like the Johor-Singapore Special Economic Zone, and growing investments in renewable energy.
All positive drivers.
The banking sector is generally seen as a stable area, attractive dividend yields. That paints a reasonably positive picture of our domestic economy, doesn't it?
Yes, I think so. A healthy banking sector, reflecting increased loan demand across various areas, is usually a good indicator of underlying economic activity and, confidence.
And the focus on infra and renewables helps too.
Definitely. Aligns with Malaysia's long-term development goals.
All right, let's now turn our attention to international news. And the big story, no surprise, is the announcement of significant reciprocal tariffs by U.S. President Trump.
The main event, really.
Effective April 9th, a 24% tariff will hit many Malaysian goods entering the U.S. It's framed as a response to, quote, unbalanced trade relationships.
The reciprocity argument.
Important to note, some sectors are exempt from Malaysia's semiconductors, pharmaceuticals, copper, lumber, bullion, certain minerals, and stuff already tariffed like steel and aluminum.
Okay, some key exemptions there.
But interestingly, a baseline 10% tariff kicks in on all U.S. imports even earlier, April 5th. This is a major development. What are the immediate implications you see?
Well, this marks a significant escalation in global trade tensions, obviously, introduces a whole new layer of uncertainty for businesses involved in international trade, including Malaysian ones.
Definitely.
The reciprocal aspect suggests the U.S. is reacting to perceived unfair practices, and the broad scope, even with exemptions, will likely ripple across various industries.
One company that looks particularly vulnerable is Apple.
Oh, yeah.
Production hubs in Malaysia face that 24% tariff on Macs. India and Vietnam face even higher tariffs. Their global supply chain is under significant pressure.
Big pressure.
And tariffs on China are set to rise to a massive 54%. That impacts a huge portion of their manufacturing. No surprise Apple's stock took a hit. Really shows how interconnected things are, doesn't it?
Absolutely. Apple's diversification strategy, which was meant to reduce reliance on any single country, hasn't really shielded them from this broad wave of tariffs.
Nope.
The increased costs will likely force them into some difficult decisions about pricing, maybe even their supply chain setup again.
The global market reaction has been quite stark. NASDAQ futures plunged 4%. Global stocks slumped. Fears of a trade war, potential recession.
Classic fear reaction.
And in times of uncertainty, investors flock to safety, right? Gold prices surged to a record high.
Safe haven play.
Even commodity markets like oil and copper dropped on concerns about slower global growth. Paints a pretty concerning picture, that immediate sentiment.
The market's reaction clearly indicates a high level of concern about the potential negative impacts on global growth and corporate earnings. The flight to gold is a classic response to increased risk.
This also throws a wrench in the plans of the U.S. Federal Reserve, doesn't it? They were already balancing inflation and trying to avoid a downturn. These tariffs complicate things, might make them hesitate on rate cuts. Why is that?
Well, the tariffs could lead to higher prices for imported goods, potentially reigniting inflation.
All right.
And that limits the Fed's ability to ease policy through rate cuts, even if the economy weakens, because their primary mandate is controlling inflation. Puts them in a tough spot.
Adding to the potential economic headwinds, there's an expectation that many U.S. businesses, who probably hadn't factored these tariffs into their forecasts, will need to issue profit warnings.
Rightly, yes.
That could further destabilize the stock market. So the impact isn't just on companies exporting to the U.S.
That's right. U.S. businesses relying on imported components or selling goods that now face higher input costs. They'll likely see their profitability squeezed. Those profit warnings could trigger another wave of market volatility.
Even the European Central Bank has voiced concerns. They warned these U.S. tariffs pose a risk to global financial stability, will dampen growth, and likely lead to greater inflation volatility. So it's not just a U.S. issue.
Definitely not. The ECB's statement really underscores how interconnected the global financial system is. Unilateral actions by a major economy like the U.S. inevitably have cascading effects across borders.
Finally, on the international front, there's this strategy being dubbed the Mar-a-Lago Accord.
Yes, heard about this.
Apparently, President Trump is aiming for a significant weakening of the U.S. dollar, rebalancing global trade through things like dollar devaluation, pressure on foreign creditors, these tariffs, maybe even a sovereign wealth fund.
Ambitious.
It's being compared to the 1985 Plaza Accord. But analysts suggest, with China's economic power and controlled currency, it'll be much harder this time, especially without broad international agreement. Sounds very disruptive.
It is indeed. The goal seems to be a fundamental shift in global economic power dynamics favoring the U.S., but as you said, the world's changed dramatically since the 80s.
Right.
China's role, its currency controls, these present huge obstacles compared to Japan back then. And the lack of international consensus makes it incredibly challenging.
Okay, let's move on to political news. How are Malaysia and other Southeast Asian nations responding? Malaysia, through MIT, announced it will not retaliate with tariffs.
Interesting choice. Diplomacy first.
Instead, they intend to actively engage U.S. authorities, seek solutions, uphold free and fair trade. The National Geoeconomic Command Center, chaired by the PM, will assess the impact, develop mitigation strategies, leveraging trade agreements, exploring new markets.
Sensible approach.
The Federation of Malaysian Manufacturers wants the government to show evidence of Malaysia's open import regime and wants industry representation on that command center. So, Malaysia's initial stance, diplomatic negotiation focused.
Yeah, that seems prudent for Malaysia. Given the complexities and potential for escalation, prioritizing dialogue is a sensible first step, and diversification through existing agreements and new markets is crucial risk management.
Other Southeast Asian nations facing even higher tariffs, Vietnam at 46%, Thailand 37%, Cambodia a severe 49% are reportedly quite concerned. Understandable.
Oh, absolutely. Those are huge numbers.
They're also seeking negotiations. Vietnam's forming a task force. Thailand's PM plans talks. Cambodia, with that huge hit to garments and footwear, is in a particularly tough spot. Seems the impact is pretty uneven across the region.
It really is. The varying tariff levels highlight the selective nature of this U.S. policy. Those economies that became big players in global supply chains, often as alternatives to China, are now facing substantial headwinds. They're understandably eager to negotiate.
So, looking back at everything we've covered today, what stands out to you as maybe the most exciting or significant development for our listeners here in Malaysia?
Well, what's particularly noteworthy, I think, is the resilience and potential opportunities seen in the Malaysian glove sector despite these U.S. tariffs.
Right, that rebound was striking.
The fact that investors are betting on their continued competitiveness in the U.S., even with a 24% levy, suggests a kind of fundamental strength in that industry. This divergence from the negative sentiment hitting other sectors, like tech, it highlights the nuanced impact of these global trade shifts.
Yeah.
It shows how specific Malaysian industries might navigate these challenges successfully, maybe even gain market share.
That's a really interesting angle, the idea that even facing broad challenges, specific sectors might find unexpected opportunities. It really underscores the need to look beyond just the headlines, doesn't it? Understand the specific competitive dynamics.
Absolutely. It reminds us that global economic events don't have a uniform impact. Careful analysis of sector-specific advantages is just crucial for investors and for policymakers, too.
Well, that's all the time we have for today's deep dive on the Malaysia Money Matters show. We hope this analysis was valuable, gave you a clearer picture of the key financial and political developments affecting Malaysia right now.
Hopefully useful insights.
If you want to stay informed and get more in-depth discussions like this, please make sure to subscribe to our podcast. Thanks for tuning in. Hey there, thanks for tuning in. If you would like a deeper dive into all the investment opportunities from today's news, subscribe to my newsletter at moneymatters.substack.com. I will be sharing a deeper analysis of the key investment opportunities from today's news, including what makes these opportunities stand out and how they fit into the broader market trends. By subscribing to the Malaysia Money Matters newsletter, you will also get exclusive insights on my watch list and portfolio and fundamental reports on Malaysian listed companies.